Hey everyone, this is Jim Fong with the Jim Fong Group at Urban Nest Realty here in Las Vegas, and today I am joined by Sean Uyehara at Loan Depot. He is a mortgage loan officer, and today we're just going to do some frequently asked questions about mortgages, and we're just going to have a conversation and we're going to learn about mortgaging a home. First of all, if you like real estate videos or market updates or just videos about life in Las Vegas, please be sure to like and subscribe to my channel and hit the notification icon so you know when videos like this are released. Oh yeah, and be sure to also head over to Sean's channel. He has a lot of great content over there that you're gonna learn a lot about Las Vegas, real estate, and mortgages as well. So today we're gonna talk about frequently asked questions. That's questions that I receive from clients that I work with about mortgages. You know, a lot of times, people are really excited to get the ball rolling on, let's go home shopping, let's go find the house, and it needs to be gated and it has a pool and all that stuff. But before all that happens, we need to get you qualified for a mortgage before we go home shopping, right? So these are just common questions that I've received over the years working with buyers, and I thought I'd bring in an expert today and we'll just kind of get straight answers for you, okay? All right, so a lot of times people ask me, Sean, like, oh, I'm a first-time home buyer, don't I qualify for some type of special financing as a first-time home buyer?
I think the first-time home buyer name gets thrown out so much. And just so everyone's clear, a first-time home buyer, all that really means is that you haven't owned a home in the last 3 years. So you could have bought and sold properties 10 years ago and you could have been renting, you would still be considered a first-time home buyer. And one of the most popular programs that we do utilize right now is called Home is Possible. It's one of the most lenient first-time home buyer programs that are out there. You just have to have at least a 640 credit score, and your household income has to be under $98,000, and we could essentially get them anywhere from 3 to 5% towards their down payment to be able to purchase a home.
Okay, so Home is Possible is like a down payment assistance thing?
Down payment assistance, yep.
For first-time home buyers?
Yep.
You gave us, what qualifications do they need besides the 640 score and?
The household income has to be under $98,000. So
under 98.
So if it's you and a spouse, we would take into account your spouse, even though they're not going on the loan. This specific program, they look at the household income.
Okay, is there any limitations on like where they can buy?
They can buy anywhere in Nevada.
Anywhere in Nevada, okay.
And it could also be a new home and as well as a resale.
And what kind of down payment is required for this program?
They will cover anywhere from 3 to 5%, and it's a sliding scale. So typically what will happen is when we're talking to a potential buyer, we will walk them through the process of getting pre-qualified, and we'll show them several options so that way they can see how the program works, whether they want the 3, 4, or 5% option, because there are some people that actually have their own funds that maybe they may want to still come in with some money to put down, or they can utilize the program for the full amount, save that for maybe covering if the appraisal comes in short, or maybe even just paying their own closing costs, depending on how you folks structure the offer with them.
So with the Home is Possible program, so it is kind of some grant money, it sounds like?
Yep, so as long as typically if they live in the home for at least 3 years, they will then forgive the amount that was given to the client.
How many years is that?
3 years.
3 years and you'll be forgiven, you don't have to pay it back.
Yep, and there are some times we've had clients that they wanted to refinance, so it's paid back in a prorated amount or forgiven in a prorated amount. So if you're in the home for 20 months, you would, and let's say you wanted to refinance, you would have to be responsible for 16 months worth of whatever's left on the balance, and then we could actually roll that into your mortgage and refinance the loan.
Very good. Okay, that's a good one. What if someone doesn't qualify for that? What if they make over the 98,000 and stuff? I mean, what other options do we have for first-time home buyers?
One of the most common programs that we utilize is with FHA financing.
Okay.
FHA is one of the most lenient programs out there.
Right.
We can actually go as low as a 520 credit score.
520 credit?
Yeah.
Wow.
So you don't even have to have great credit. And I think that's also another myth in the housing industry, is that you have to have impeccable credit or you have to have at least a 720. I think that's the number that usually gets thrown around. But every lender is going to be a little different. So make sure that you do some due diligence with whoever you decide to help you with your financing, because every lender is going to have different criteria. At Loan Depot, like I said, we can go to a 520. So if your credit score is under a 580 to the 520 mark, we would actually need 10% down. But typically on an FHA loan, it's only 3.5%.
Right. I mean, most of our first-time home buyers do use FHA loans, right. And a lot of times we do that because it is like the 3.5% down. Yeah. So you're saying with a lower credit score, they could get an FHA loan still with a higher down payment.
Higher down payment. Yep.
Wow. Okay. Cool. And FHA loans generally have really good interest rates.
Very competitive interest rates. It's backed, by the government, by HUD, so it's geared towards the first-time home buyer. So whether you have a 650 or a 720, you're still going to get a very competitive interest rate. I know a lot of times when first-time home buyers are thinking of buying, they want the perfect credit score, the perfect everything before they talk to a lender. When in actuality, even at a 640, you would still get a really competitive rate. And even if you're at a 580, you're still getting a competitive rate.
No, that's really true. A lot of times when I talk to people that want to buy a house, they often think that they're not ready yet, and then after they apply for a mortgage, it turns out that they're totally ready to go, right?
Yeah, absolutely.
So what limitations do you see with FHA loans?
The biggest limitation is the loan limit. So
okay, what's
here
the limit?
In Clark County, it's about $360,000.
Okay,
but it gets assessed every single year, and I think with the way the market's been going here in Las Vegas, with values going up, I think they're going to increase it again. But every single county across the country may have a different loan limit. So just because we say here in Las Vegas we're at 360, and you could be buying a house in California, that loan amount is going to be a little different. So make sure you check with a local lender for that information.
So when you say the loan limit, so that doesn't include the down payment then, right? So they can borrow up to the 360,
correct.
And if they're putting down payment down, that goes over that price, right?
Correct. Yep. Okay. So if they were to buy a house for, let's say, 375, but they had maybe 15 grand to put down, then as long as they're under that amount, then we could still look at FHA financing.
Excellent. Okay, cool. Something I've also I've worked with buyers in the past too that are veterans, right? They served in the military. They qualify for a VA loan, which is such a great loan, right? I wish I had qualified for it. Tell us, what are the qualifications for that?
No money down.
Yeah, right.
No money down.
Zero down. You get money back at the end.
It's one of the best loans. The sad thing is not a lot of veterans understand it, or they don't take advantage of it. And one of the biggest myths about a VA loan is that you can only use it once, which is false.
You can do more than one
VA
VA loan?
More than one, yes.
Not at the same time though, right?
You can use it at the same time. It depends on how much eligibility and entitlement you have.
Okay.
So it depends. That's where you would just need to get with a lender, because we would need to see how much entitlement's left in order to try to calculate and how much we can make it work for both properties.
What do you mean by entitlement?
So basically, every veteran that's eligible for VA financing, they're going to have to get their DD-214, which is their discharge paperwork, and then their certificate of eligibility, and that gives us as a lender the information that we need in order to calculate what the veteran can potentially qualify for.
What is that form called again?
Certificate of eligibility and their DD-214.
DD-214.
Yep. Those are the two most important documents for a veteran when they're going to be looking for financing on a home.
Yeah, so VA loans, so there's no down payment, there is really low interest rates, and is there
no mortgage
insurance, right? Okay, so no mortgage insurance. Wow, if someone qualifies for that, why wouldn't they use it?
Yeah, it's one of the most underutilized, I think, programs out there.
Okay.
I think even some veterans, sometimes they want to put money down,
right?
And go another route with maybe conventional or FHA, but I mean, to me, you've earned the right to use that loan, that benefit, and I think, why not take advantage of it?
Here's a question that's a little personal to me, I guess. My sister and my brother-in-law, I guess, they both served in the Air Force, right? They're both veterans, right? In that situation, could they do two VA loans, or is it, since they're married, they only get to use one now?
I believe they each have their own entitlement, so they could go and purchase their own properties. And sometimes what a lot of veterans, what we've seen them do is they will, let's say they're stationed here at Nellis, here in Vegas, they'll buy a property and then maybe they get relocated somewhere else, but they'll turn that into a rental.
Right.
And then if they still have some eligibility left, they may use that to buy another property, or in that case, maybe the spouse could use their VA to be able to purchase. So,
Maybe buy a vacation property or.
Yeah.
Okay.
It's a great way for them to build wealth and some passive income, throughout their career.
Well, and then so I wanted to ask you about what if somebody is not does not qualify for a VA mortgage, and they don't want to do a FHA loan because of they're buying a higher price property, perhaps, right? What options do they have at that point?
We're going to be looking at conventional financing. And that's typically, you're going to have somebody with a little better credit score. They may have a little more money to put down. Typically on a conventional loan, you're looking at, on a primary residence, 3 to 5%. Again, the big myth out there is you have to put 20% down, and that's not the case. You can still put less money down. And a lot of times people that want to do the 20% down, they're doing that so they can avoid the mortgage insurance.
Sure.
But there's actually ways you can put less than 20% down and not have mortgage insurance.
Really? Check out the next video, right? All right.
Yeah, and that's where I always stress to our clients, make sure that your lender that you're talking to gives you several options when you get pre-approved.
Right.
To me, every time I speak to somebody and they say, I want to put 20% down, I immediately know why they want to do it, but let's probe a little more, because if we can do it, let's say with 10% down, and you still don't have the mortgage insurance, and let's say you're buying a $400,000 home, I just saved you 40 grand in down payment money. Maybe you can use that to fix the house up, cover your closing costs, or however you need to have that extra money. If you're relocating here, that's a huge help, to be able to help the buyer.
So with conventional mortgages, does better credit give you a better interest rate?
Typically, yes.
Okay.
Because the other factor is we do have to account for the mortgage insurance if there's going to be a premium that's paid. So we also have to look at credit scores when qualifying somebody on a conventional loan. Okay. Not saying that if you're under a 700, you're not going to get a mortgage. We still we do have other options, but that's where the pre-approval is super important, because we got to know what credit score we're dealing with. Because a lot of times they may go to Credit Karma and say, hey, I think I have a 750, and then I might pull it, it might be a 650. Okay. Huge difference there, and now it might throw off who we can go to for mortgage insurance coverage or how we need to structure the loan.
All right, what if someone has a conventional mortgage and they put 5% down, right? And we've seen the market increase the way it has, and now they have a lot more equity. Does the mortgage insurance drop off when you get to that equity on the house?
You can call your servicer who you're making your payments to. Sometimes people, I've done this on my own mortgage to see if they had some type of internal program, because sometimes they'll just order an appraisal and they may just do it for a very minimal cost.
Right.
If they don't, then you could refinance with a lender and be able to take advantage of the equity in the house, get rid of your mortgage insurance, and see if you can even lower your interest rate as well.
I mean, I had a conventional mortgage in the past too, and I think I paid for an appraisal to prove the value, and they were able to drop the MI based on that too. So cool. And from the realtor perspective, when making offers, I don't know why this is the case, but the perception I get from listing agents or selling agents is that conventional offers are stronger than FHA for some reason. I get that a lot. I mean,
what's your take on that?
I mean, I don't think it. I personally do not think that it's the loan that is weaker or stronger. I think in general, with the lower down payment, people may feel like it's not as strong as an financing as if they went with a conventional. I mean, do you think that's true? I mean, that's kind of the perception that there is in the real estate industry.
I like to argue that point.
Okay.
Just because my case in point is a VA loan. I've heard numerous listing agents say that they don't want to take a VA loan. And I always ask why. Because the veteran earned the right, you know, they qualify with a lender, and just because they're putting nothing down, that doesn't mean that that's a weaker borrower.
True.
I've had veteran clients that put no money down, but they've got $250,000 in the bank.
Right.
So, there's nothing wrong with the financing, and that's where I think with VA loans especially, not a lot of people understand them, and even people that are in the industry, and I think it does a disservice because these men and women are fighting for our freedom and they have the right to use a loan, and some listing agent saying, I don't want to take your deal because you're putting no money down.
Right. Anything else you want to, I mean, the down payments, I guess, right? There's a lot of different things about down payments. I get a lot of questions too, first time home buyers. A lot of times people, hey, my parents want to help me put some money down and stuff. I mean, are there restrictions on where you can get your down payment for each of these different mortgage types?
The biggest thing is going to be that a lender has to verify where the funds are coming from. Here in Las Vegas, a lot of tip earners. Cash is a big no-no in the banking world. Because we have to be able to track where the money came from. If not, there's the anti-money laundering disclosures that everyone has to sign, and with banking, we have to track and trace the funds, because if not, it could be they're trying to drug money. I mean, there's so many different things that can come up. That they're trying to wash money on the back end by buying homes. So as a lender, make sure that if you are looking to buy, and let's say you do have cash, there's not a bad thing. You just have to communicate that to your lender so we can best help you structure how to be able to qualify.
So it's okay to have cash, but talk to your mortgage lender before you just deposit in the bank or something like that.
Or if you might have got some bad information and a lender said you can't buy, when that's not the case. We just have to structure it a little differently. And to your question a little bit ago, yes, you can also get gift funds from a family member as well that can help you with a down payment.
Is it just family members that you can receive gifts?
Just family.
Really? Okay. How do you feel about that?
I think you have to draw the line somewhere, because if not, you could say...
How do they prove family?
I think what happened in the crash, a lot of people were saying maybe they were family, or just getting random people and taking advantage of people to say, I want to use your credit to buy this house. I'll put the money up, but we're going to finance it in your name. And that's actually, a straw buyer, which a lot of people got burned because they thought that was going to be an investment for them, when in actuality, the guy was just taking advantage of utilizing someone else's credit.
Wow. Okay. And are there, any key takeaways for when borrowing money for down payments? What's the key thing?
I think the biggest thing is actually speaking to a lender and coming up with a game plan, because even if you don't have the money or you're thinking of getting it from a credit card or some of these payday loan places, talk to your lender first, because you want to make sure that you're not going to do something that's going to jeopardize the loan, even though you might think it's a good thing, or hey, it's not an issue. In lending, it may become an issue. I had a client once that they were trying to build up their credit, so they kept taking out payday loans. They would take them out, pay them off, take them out. They had like 30 on their credit report.
Wow.
And I was like, well, why are you borrowing money? He said, well, it's good that I'm paying off these loans. I'm like, no, you're showing us that you don't know how to manage your money, and you're borrowing money to basically live. So a guy like that, he actually kind of shot himself in the foot, because he thought he was doing something good for himself, when in actuality it hurt him when it came to qualifying.
We're talking about mortgages. Interest is always going to come up into play, all right? So, obviously everybody wants to get the best interest rates and things like that. What things can people do to improve their interest rate on the mortgage?
I think when you shop around for your mortgage, to me, the most important thing is trying to build a relationship with your lender. Because I know a lot of times customers will go online, they'll go to, Lending Tree and all these other e-lenders or online lenders, and they're attracted by the low interest rate.
Yeah.
You have to remember to read the fine print, because they're not, a lot of people will look at, say, oh, I want the 2.5% rate.
Right.
But then the stipulation states you have to have a certain credit score, a certain loan amount, a certain loan type.
Okay.
So there's all these other factors that go into determining what the rate is. And a lot of times I feel customers will just get so excited and enamored at the interest rate, they think, well, I'm gonna get the 2.5 without reading all the disclosures. And then sometimes it bites them in the butt. I mean, I've had clients that they've told us, hey, I can get a better rate somewhere else. They go somewhere else and that lender couldn't perform, and then they come back. And the market changes and now the rate's higher. So be careful when shopping.
So tell us a little bit about, while we're talking about interest rates, tell us a little bit about buy downs, I guess.
So one of the options, you can pay additional fees to buy your interest rate down. So typically it's done on a percentage basis, and normally you'll pay maybe 1 point to get a lower interest rate.
So 1% of the loan amount
is 1% of your loan amount.
And that could buy down your rate a little bit.
Lower interest rate.
Generally, what is 1 point buy down?
Maybe about 1/4%.
Do you think this is ever worth it?
It depends on how long you plan on keeping the property.
Okay.
And it also depends on where that break even is.
Sure.
So you'd want to compare the par rate, which means there's no additional cost to get the interest rate, and the buy down, and the monthly savings, and how long it takes you to recoup the buy down cost by the monthly savings. And for some people, it might be 3 or 4 years, but if you're selling within that time frame, then take the higher rate and save the extra, few $1,000.
Right. And if you plan on living there forever, might be worth the buy down.
Might be worth taking the buy down, especially last year. Rates got really low. I mean, I paid 2 points on a rental property that I had, and my rate's 2.375.
Crazy.
I'm keeping that house forever. It's going to go to my daughter. So I didn't mind paying the extra money, because I knew my long-term goal was to hold this property, and 2.3 on a rental is unheard of.
Unless you're a mortgage loan officer. No, that's good. Well, that's the video today. I think we covered a lot of stuff. If you have more specific questions or something, please leave a comment below. Either Sean or I will get back to you, or we might even do a follow-up video for you. So thanks for watching. Please, if you found this video helpful and informative, please be sure to give me a like and subscribe to my channel. Be sure to check out Sean's channel as well. You'll see a link in this video. My name is Jim Fong with the Jim Fong Group at Urban Nest Realty. This was my guest, Sean Uyehara. Thank you so much for watching. We'll see you next time.